trying to keep up with the financial health and strategic moves of giant like Tata Motors can feel like decoding a real puzzle, right?
It really can. There's a lot going on.
Well, today we've got their latest investor presentation. This one's from May 13th, 2025.
Okay.
And it's a detailed look at how they performed in the last quarter, Q4, and also the whole financial year ending this past March.
Right. So a full picture.
Exactly. We're not just looking at the big Tata Motors group overall, but also zooming in on Jaguar Land Rover
JLR. Yeah.
and their commercial and passenger vehicle businesses too.
So all the main pillars.
Our goal in this deep dive really is to cut through all that complexity and pull out the key insights, the stuff that actually matters to you.
Yeah. Think of it as getting the essential intelligence without having to wade through, hundreds of pages yourself.
Right.
We want to make sure you understand the significant shifts and maybe what they could mean going forward.
Okay, let's do it. So starting with that big picture view, the Tata Motors Group overall, one of the first things that jumps out is their highest ever annual profit before tax and exceptional items. It hit 34.3 trillion.
Wow. Okay. That's a massive number.
It really is. What should we take away from that headline figure?
Well, that record profit, it really signals strong underlying performance across their businesses, doesn't it? It suggests their strategies are paying off and they're, managing operations effectively to generate significant earnings.
And that kind of profit fuels future investment, right? R&D.
Exactly. R&D, maybe higher returns for shareholders eventually. It gives them options.
That makes sense. And building on that positive picture, they've also moved into a net auto cash position of 1 trillion.
Right.
What does that actually mean in simple terms?
Essentially, it means that for their automotive operations, the cash they have on hand now actually exceeds their debt.
Okay.
Which is a pretty significant turnaround from where they were having net debt. Gives them considerable financial flexibility.
Fewer constraints, more strategic options.
Precisely. They're not as heavily burdened by debt repayments.
Definitely a sign of strength. And it seems the market agrees, because their credit ratings have improved too.
Yeah.
Both S&P and Moody's bumped them up by 2 notches this year, and Crissella and ICRA each gave a 1-notch upgrade.
That's significant movement.
Can you give us a bit of context on why these ratings matter so much? Like S&P went from B1 stable back in May 2021. Now they're B1 positive as of March.
Yeah, think of credit ratings like a report card on a company's financial health, basically.
Okay.
Higher ratings, like these upgrades we're seeing, generally mean a lower risk of default.
Right.
And that can lead to lower borrowing costs for the company. Plus, it often signals increased confidence from investors about their future financial stability.
So that consistent upward trend is key.
Absolutely. It shows sustained improvement in how these agencies view Tata Motors' creditworthiness.
Right.
It's not just a blip.
Got it. Now, for anyone following the stock, there's news on the dividend front. A proposed final dividend of 6 sigras per share, which is 300% of the face value. It adds up to a euro 2,209 CR payout.
That's quite a payout.
And it looks like it's pretty much a done deal. Almost all shareholders, 99.9%, approved it back on May 6th.
Wow, 99.9%.
Yeah. What's the significance of such a high approval rate?
Well, that kind of near-unanimous approval really underscores the strong alignment between the company's management and its shareholders.
Okay.
It suggests investors are, pretty happy with the company's performance and its decision to share profits through dividends. It's a good indicator of overall shareholder confidence.
Right. Definitely a vote of confidence.
Yeah.
Okay, let's switch gears a bit to a major structural change they've got planned, the demerger.
Ah, yes, the separation.
The plan is for it to kick in around October 1st, 2025, with the appointed date set for July 1st. They're saying the operational separation is on track.
Okay, so things are moving along.
What's the core idea behind a move like this? Why demerge?
A demerger like this usually aims to create more focused business units. So by separating the commercial vehicles and passenger vehicles businesses, the thinking is that each entity can pursue its own strategies more effectively. Maybe attract different types of investors too. And unlock value. Potentially, yeah. Unlock value that might have been sort of hidden within the larger combined structure. The different dates you mentioned likely just refer to the legal separation versus when they'll be fully operating independently.
Makes sense. Let's touch on some government support they've received. Tata Motors got 142 CR through the automotive PLI scheme for the last financial year.
Okay, the production-linked incentive.
Yeah. And they're expecting another 385 CR for this past year, FY25, based on meeting domestic value addition criteria and completing audits.
Right.
How should we interpret these numbers? Is this significant?
Well, these figures show that Tata Motors is actively participating in and benefiting from government initiatives designed to boost local manufacturing. That's the point of the TLI scheme.
Rewarding local production.
Exactly. It rewards companies for increasing their domestic production and value addition. So this accrued income shows Tata Motors is successfully aligning its operations with those policy goals.
Okay. Another significant financial move was the completion of the Tata Motors finance merger with Tata Capital Limited.
Right, that restructuring.
The report mentions that the vehicle financing arm is now mostly just the leasing side of things, and crucially, they've adjusted the previous financial numbers for a clearer comparison.
That restatement is important.
Why is restating those past figures important for us to know?
Well, when a significant business unit like the financing arm is restructured or merged out, restating prior numbers gives you a proper like-for-like comparison.
Apples to apples.
Exactly. It allows analysts and investors to understand the ongoing performance of the remaining business without being misled by, the inclusion of the now merged operations in previous periods. It just ensures a cleaner, more accurate view of the current trends. Got it. Okay, let's dive into the group's performance in the last quarter, Q4 of FY25. Revenue edged up slightly, just 0.4% year-over-year, to 119.5 trillion.
Okay, pretty flat on the top line.
Yeah, but the report breaks it down. Selling more and the types of vehicles sold, volume and mix, added 3.4%. Pricing added another 0.4%.
So positive underlying drivers.
Right, but then currency fluctuations took away 1.2%, and other factors accounted for another 1.6%.
So headwinds balanced out the gains.
Seems like it. What's the key takeaway here, then?
Well, while the overall revenue growth was modest, I think it's encouraging that the core drivers selling more vehicles, getting better prices, were actually positive.
Right.
The negative impacts from currency and other areas suggest, headwinds they had to navigate during the quarter. It highlights that the underlying business strength was there, even if external factors dampened the headline growth rate.
Okay, but the profit picture for the quarter looks healthier. Profit before tax and exceptional items rose by 8.8% to 3.4 trillion.
That's a decent jump. And again, volume and mix contributed positively, pricing too. Currency had no impact this time, and others had only a minor negative effect.
So profitability improved more strongly than revenue.
Exactly. And what's particularly interesting is the jump in their operating profit margin, their EBIT margin. It went from 8.8% last year to 9.6% this Q4.
Okay, that's a significant margin expansion. What does that tell us?
Well, that improvement in the EBIT margin indicates they're becoming more efficient at turning their revenue into profit from their core operation.
Better cost management, better product mix.
Could be either or both. Better cost control, maybe selling more higher margin vehicles. It's definitely a strong sign of improved profitability in their day-to-day business.
That makes sense.
And looking at the entire financial year, FY25, the consolidated revenue reached 437.0 trillion. That's a slight increase from the previously stated euro 434.0 trillion after those restatements we mentioned.
Right. So still growth for the full year.
Yep. And profit before tax also saw a good increase, up to 34.3 trillion from euro 29.4 trillion.
Consistent improvement there, too.
And just like the quarter, the full year operating profit margin, EBIT margin, improved as well, from 8.0% to 8.7%.
So it's a consistent trend, not just a Q4 thing.
Exactly. These full year results really reinforce the positive momentum we saw in the fourth quarter. The consistent improvement in both profit and profit margins suggests that the strategies they've put in place are having a sustained positive impact.
Good signs overall, then.
Let's dig a bit deeper into their debt situation. We mentioned the shift to a net cash position overall, which is great.
Yes.
But looking at the different parts of the business, TML India still has net debt, around negative 5.6 trillion rupees. JLR also has some net debt. But TML Holdings has a significant net cash position, over 7 trillion rupees.
Okay.
How should we interpret these different internal figures?
Well, it's pretty common for different entities within a large group to have varying levels of debt and cash.
Right.
The parent holding company, like TML Holdings here, often manages the overall group financing and might hold more central cash reserves.
While the operating units have their own needs.
Exactly.
Yeah.
Individual operating units like TML India or JLR might have debt related to their specific investments, maybe factory upgrades or R&D projects. The key point is that the group as a whole is in a net cash position.
meaning the cash held centrally outweighs the operating debt.
Precisely.
And this move to net cash isn't sudden. It's part of a much longer trend. They've significantly reduced their net automotive debt from a huge euro 21.9 trillion way back in FY10
Wow, that's a massive reduction.
down to this net cash position now in FY25. That's a pretty remarkable turnaround over 15 years.
Absolutely. That long-term deleveraging story really highlights a disciplined focus on strengthening their financial foundation over many years.
Shows commitment.
Yeah, a real commitment to reducing financial risk and building a more resilient balance sheet.
Okay, finally for the group overview, let's talk about cash generation. Specifically, the cash generated by their core domestic automotive business, so commercial and passenger vehicles combined.
Right, the free cash flow.
For FY25, they generated a healthy euro 6.9 trillion in free cash flow.
That's a solid number.
And the report gives us a breakdown of how they got there. Starts with profit, adds back non-cash stuff like depreciation, subtracts taxes and investments, and then accounts for changes in working capital.
Mm-hmm.
And it seems like efficient management of things like payables and receivables played a positive role here.
That's crucial. Why is strong free cash flow so important?
Well, strong free cash flow is vital because it represents the actual cash a company generates that's available after all expenses and investment.
The money they can actually use.
Exactly. It's cash available for reinvestment in the business, paying down debt further, returning capital to shareholders through dividends or buybacks, or maybe pursuing strategic opportunities like acquisitions.
And the working capital point.
The fact that working capital management contributed positively indicates they're efficiently managing their day-to-day operations, like collecting payments from customers faster, maybe managing inventory levels better, negotiating payment terms. It all adds up.
Good operational grip.
Seems like it. All right, let's pivot now and turn our attention specifically to Jaguar Land Rover, or JLR.
Okay, JLR. Always interesting.
For their full financial year, FY25, they reported revenue of $28,961 million. That's actually a slight dip year over year.
Revenue down slightly. Okay.
However, their profit before tax saw a significant jump, reaching $2,489 million.
Wow. Okay, so revenue slightly down, but profit way up.
Exactly. That's a big increase in profitability despite a minor revenue decrease. What's driving that?
That's a key point, isn't it? The increased profitability, despite slightly lower revenue, strongly suggests that JLR has been really successful in improving its cost efficiency. Could be several things, maybe better procurement, streamlined operations, or perhaps a deliberate focus on selling higher-margin vehicles like their Range Rovers.
Focusing on the profitable models.
Could be. It indicates a stronger ability to convert each pound of revenue into actual profit. Better margin management, essentially.
And that improved profitability is also clear in their operating profit margin, their EBIT margin. It rose to 8.9% for the full year.
Pretty healthy margin for an automaker.
And what's interesting is the trend throughout the year. It started FY25 at 5.1% in the first quarter,
Okay.
then climbed steadily to 9.0% in Q2, and peaked at 10.7% in Q3, before maybe settling slightly. What does this upward trajectory within the year tell us?
Well, that consistent improvement in their operating margin over the quarters suggests that whatever efforts they were making to enhance profitability were really gaining momentum throughout the year.
Things started clicking.
Seems like it. It could reflect the impact of cost-saving initiatives kicking in more fully, or perhaps the successful launch and strong sales of more profitable models as the year progressed.
Right. They also generated a solid $1.5 billion in free cash flow in FY25.
Still a very strong number.
It is, although it's actually a bit lower than the previous year. Should we be concerned about that decrease?
Well, while any decrease in free cash flow warrants attention, $1.5 billion is still a substantial amount, indicating healthy cash generation.
So what could explain the drop?
The lower figure compared to the previous year could easily be due to increased investments. Things like developing new electric vehicle technology, upgrading factories, new product development.
Stuff that costs money now but pays off later.
Exactly. Investments that impact immediate free cash flow but are absolutely crucial for future growth, especially in the EV space. So probably not a major red flag on its own.
Okay. Looking at how many vehicles they're actually selling, their wholesale numbers, so cars sold to dealers, for FY25, that totaled 348,000 units.
Right.
But what's really striking is the shift in what they're selling. Battery electric vehicles, BEVs, and plug-in hybrids, PHEVs, now make up 63% of their wholesale volume.
Wow, nearly two-thirds.
Yeah. While traditional internal combustion engine, ICE, cars, gasoline, and diesel are down to just 16%. That's a massive change from previous years.
That is a dramatic shift. It clearly demonstrates JLR's strong strategic focus on electrification. They're really pushing it,
Ramping up production of EVs and hybrids.
significantly increasing the production and availability of their electric and hybrid models. They're positioning themselves very deliberately for the future of the auto industry.
And drilling down into the last quarter, Q4 of FY25, they saw an increase in wholesale volumes in both the UK and their overseas markets compared to the previous quarter, Q3.
Okay, so positive momentum towards the end of the year.
Seems like it. So just strengthening demand, perhaps?
Yeah, that quarter-on-quarter growth in key markets is usually a good sign. Suggests strengthening demand for JLR vehicles in those regions, which is a good indicator looking forward.
But then you look at the retail side, the cars actually being sold to customers in Q4.
Right, the end demand.
The picture there is a bit different from those wholesale numbers. Only 15% were BEVs and PHEVs.
Oh, okay, so much lower than the 63% wholesale figure.
Yeah. 30% were mild hybrids, MHEVs, and 55% were still traditional ICE engines. Why the big difference between what they're producing wholesale and what's being bought at retail?
That's a really interesting gap. It likely reflects a strategic push by JLR to increase the supply of their electrified vehicles into the dealer network.
Building inventory ahead of demand?
Could be. They might be aiming to build inventory, make them readily available, maybe run promotions to encourage greater adoption.
Yeah.
Even if current consumer demand hasn't fully caught up with their ambitious electrification production goals yet.
Other factors?
Oh, sure. It could also be influenced by things like charging infrastructure availability in different markets, maybe lingering consumer preferences or anxieties about EVs that are still evolving. It's complex.
Okay. Let's quickly look at how that $1.5 billion in free cash flow was generated. It starts with their profit, adds back non-cash items, subtracts taxes to get cash profit.
Right. The usual bridge.
Then they deduct their investment spending, which was significant, and also factor in changes in working capital to arrive at that free cash flow figure.
And working capital played a role again.
It seems like how they managed payables, receivables, inventory.
Absolutely. That breakdown, the free cash flow bridge, shows the key drivers. An efficient working capital management, collecting cash quickly, optimizing inventory is always crucial for maximizing the cash available.
And just like the overall Tata Motors group, JLR has also been steadily reducing its net debt over the past few quarters.
Another consistent theme.
Seems to be a clear financial priority across the board.
Yes, this consistent reduction in net debt at JLR further reinforces that commitment to strengthening the balance sheet, reducing financial leverage, more stability, more flexibility.
JLR is also making a specific effort to protect its profitability, its EBIT margin, through something they're calling an EBIT protection task force.
Okay, what does that involve?
They're focusing on things like improving warranty governance, maybe reducing warranty claims or costs, managing commodity costs better through workshops, deploying more field service engineers, assessing regulations carefully.
A multi-pronged approach.
Seems like it. What's the underlying goal here?
The goal of these initiatives is clearly to bolster the bottom line by proactively addressing factors that can erode profitability.
Like unexpected costs.
Exactly. Better warranty management reduces those unexpected costs. Controlling commodity prices helps maintain production margins. Better customer service can lead to greater loyalty, repeat business, maybe even better pricing power down the line. It's about protecting those hard-won margins.
Makes sense. Interestingly, the report mentions that JLR is reevaluating its financial outlook because of the recent UK-US trade deal that was announced on May 8th.
Ah, okay.
They're going to provide an update in June at their Investor Day.
That suggests this deal could have some pretty significant implications for them, doesn't it?
You'd think so.
Yeah, trade deals can impact everything from tariffs and import-export costs to supply chains and market access rules. So it's vital for a global company like JLR to assess how this new agreement might affect their costs, their pricing, their competitive position. Their updated guidance will definitely be something to watch for in June.
Okay. Turning now to their joint venture in China. The numbers for the last quarter of FY25 show a bit of a mixed picture.
How so?
Well, both retail and wholesale volumes were down compared to last year and the previous quarter. Revenue was also down.
Not ideal in a key market like China.
No. However, while they still reported a loss after tax for the quarter, -9 million pounds. It was actually an improvement compared to the loss in the previous quarter.
Okay, so sales down, but loss narrowing sequentially.
Exactly. What should we make of this?
Well, the decline in sales volume and revenue in China is definitely a concern, as it's such a significant market globally.
Right.
However, that sequential improvement in profitability, narrowing the loss, suggests that maybe efforts to turn things around in the China JV are starting to have some positive effect, perhaps on the cost side.
Working on efficiency.
Could be.
Yeah.
It indicates they're likely working hard on improving efficiency and reducing losses in that region, even if the top-line sales haven't recovered yet.
Okay. Operationally, JLR benefited from favorable currency exchange rates in the last quarter. That added 56 million year over year to their results.
On a nice tailwind.
And the total positive impact from both currency and commodity prices was even larger, at 141 million compared to the previous year.
Wow, that's quite significant.
It seems like it.
Yeah, favorable exchange rates and commodity price movements can provide a really significant boost to a company's profitability. They can reduce input costs, like materials, and also increase the value of overseas earnings when converted back into pounds.
So managing that exposure is key.
Absolutely. Effective management of these FX and commodity factors can have a substantial impact on the bottom line, both positive and negative. They got a nice boost here.
And finally, for JLR, they ended the financial year with a strong liquidity position. They had over 6 billion pounds in total liquidity cash and available credit lines,
Okay.
compared to around 4 billion pounds in total borrowings. That looks like a comfortable buffer.
Yeah, that strong liquidity position gives JLR a good safety net. It helps them weather any market uncertainties and provides the financial strength to keep investing in their future growth plans, particularly around electrification, without being overly stretched.
Good position to be in. Okay, let's shift focus now to Tata Commercial Vehicles, the CV business.
Right, the trucks and buses side.
The report highlights their domestic market share based on VAHAN registration data, but it includes an important note. This data doesn't cover all states, and it can be subject to revision later.
Yeah, that's a standard caveat, but always worth remembering. VAHAN data gives a good indication, but it's not always the complete final picture due to those exclusions and potential updates.
Good point. Now here's an interesting highlight. Despite a dip in their revenue for the full financial year FY25.
Okay, revenue down here too.
Yes, but despite that, Tata Commercial Vehicles achieved their highest ever absolute EBITDA. That's earnings before interest, taxes, depreciation, and amortization.
Highest ever EBITDA on lower revenue.
And their highest ever PBT before exceptional items as well.
Wow, okay. How did they manage that? That's impressive.
It is. They also consistently delivered double-digit EBITDA margins throughout the entire year.
That really suggests a strong focus on profitability. It implies they've likely improved their pricing power, maybe through value-added features or services,
Her cost control.
or optimized their cost structure significantly. Or perhaps shifted their sales mix towards more profitable, higher-end trucks or buses. Achieving record profitability despite a revenue decline points to really strong operational efficiency and margin management.
Looking at the last quarter, Q4 specifically, their operating profit, EBIT margin, was a healthy 9.7%. That's slightly up from the same period last year.
Still strong.
Their profit before tax, PBT-BE, was also up, reaching 2.1 trillion.
Yeah.
And the report breaks down how different factors like sales volume, pricing realizations, variable costs, fixed costs, and FX contributed to that year-over-year PBT increase.
Right, that bridge analysis again.
Yeah, it helps show the specific levers they pulled.
Exactly. It lets you see, okay, did the profit increase come mainly from selling more, getting better prices, cutting costs, or some combination? It gives a more nuanced understanding than just the headline profit number.
The report also gives some interesting insights into the commercial vehicle industry as a whole in India.
Okay, the market context.
Overall industry volumes, TIV, saw a marginal year-over-year improvement in Q4, led mainly by trucks and passenger carriers.
So the market was slightly up.
Yeah. They also note that average fleet utilization improved QoQ, and transporter profitability saw a marginal improvement. Freight rates also saw a QoQ improvement in Q4.
Those are positive signs for the sector's health.
Seems like it. Commodity prices were apparently range-bound, pretty stable, although they're keeping an eye on the impact of steel import duties.
Right, steel being a major input cost.
Hmm.
What's the overall picture these indicators paint?
Well, these industry indicators provide valuable context. They suggest a relatively stable to slightly improving market environment in Q4.
Which would have certainly helped support Tata CV's positive results.
Exactly. The improvement in things of freight rates and transporter profitability is particularly encouraging. It means the end users, the transport operators, were doing a bit better, which often translates to better demand for new vehicles eventually.
Makes sense.
So some key highlights for Tata commercial vehicles themselves in Q4. That slight improvement in overall industry volume helped. Their own truck and passenger carrier sales registered healthy growth.
Good performance in key segments.
Yeah, and interestingly, digital contribution to their retail sales reached about 27% in Q4, which was an increase from Q3.
Okay, so digital channels becoming more important.
Seems so. They also highlight their focus on improving fuel efficiency and reducing the total cost of ownership TCO for their customers.
Always critical in the CV space.
I mentioned progress on their digital platforms like eDucan and Fleetverse.
So they're hitting on multiple fronts.
Mm.
Product efficiency, digital engagement, cost focus.
Yeah, these highlights demonstrate a proactive approach. By focusing on digital sales, fuel efficiency, TCO, they're adapting to evolving industry trends and what their customers need.
Right. What about looking ahead? What are their priorities for this current financial year, FY26?
Okay, their focus areas for FY26 include sustaining momentum while specifically winning back market share in the small commercial vehicle SCV segment
Targeting
and
SCZs.
ensuring a smooth transition for the upcoming AC regulation in trucks, but doing it with value enhancements for customers.
So turning a regulation into a potential plus.
Continuing to expand their product portfolio with digital solutions and new launches. Improving their Vahan market shares across all segments, but again, specifically focusing on SCBs, mentioning the Ace Pro launch coming in Q2.
So growth and market share are key.
And importantly, continuing to deliver strong double-digit EBITDA margins, strong cash flows, and good return on capital employed, ROCE.
Balancing growth with profitability sounds like a busy, focused year ahead for them.
It certainly does. A clear strategic direction, balancing growth ambitions with that profitability focus, while also navigating regulatory changes and market dynamics.
Okay, that covers CVs. Let's move to the last piece, Tata passenger vehicles.
Right, Tata Passenger Vehicles, or PV, including their increasingly important EV business. So for the last financial year, FY25, they held a 13.2% share of the domestic passenger vehicle market, based on Vahan data again.
Okay, maintaining a solid share, over 13% in a very competitive market. That's quite respectable.
And their powertrain mix in India for the year shows real variety now. About half, 51%, were petrol. Diesel is down to 13%.
Okay.
But look at this. EV is up to 11%, and CNG is now a significant 25% of their mix.
Wow, CNG at a quarter. That's huge growth. And EV at 11% is also very strong.
Definitely seeing that shift towards alternative fuels. And related to that, they note their overall portfolio emissions continue to trend well below the official CAFE norms the government targets.
Good on the compliance front, then. That diverse powertrain mix really shows they're catering to different consumer needs, fuel prices, environmental concerns, and also proactively meeting those regulations. The growth in CNG and EVs is really noteworthy.
Speaking of EVs, their EV volumes saw significant year-over-year growth, reaching almost 22,000 units, 21,742 to be exact, in FY25.
That's substantial growth. Underscores their increasing presence and, frankly, success in the rapidly expanding EV market in India. Yeah. They were early movers there.
They were. Now, the report also gives us a fascinating financial breakdown, splitting their traditional PV business, ICE, petrol diesel, from their EV business for FY25.
Oh, interesting. How do they compare?
Okay, so the traditional PV ICE business generated over 40.3 trillion in revenue with an EBITDA margin of 8.1% and a profit before tax, PBT Bay, of 1.0 trillion. Pretty healthy.
Okay, solid performance from the core ICE business.
But the EV business, while bringing in 8.1 trillion in revenue,
Still significant revenue.
had a much lower EBITDA margin of just 1.2%, and that's after accounting for PLI incentives. Before product development expenses were factored in, the margin was better, but still only 6.8%. The final PBT for EVs was just slightly positive at euro 0.1 trillion.
Ah, okay. So EV revenue is growing nicely, but profitability is still much lower than ICE.
Exactly. It seems the heavy investments in developing EVs, R&D, manufacturing setup, maybe initial lower scale, are still significantly impacting their bottom line compared to the established ICE cars.
That financial split really highlights the different maturity stages, doesn't it?
Yeah.
The established ICE business is profitable, funding the growth and investment phase of the EV segment. Lower profitability in EVs is pretty typical during these early stages due to those high upfront investments. The revenue growth is the key positive signal for EVs right now.
Right. Looking at the broader passenger vehicle market in India last year, FY25,
What were the trends?
it saw modest growth overall, about 2% industry growth, reaching 4.3 million units. Demand was apparently a bit muted, maybe driven by heavy discounting from various players.
Yes. Okay, tougher market.
Segmental shifts continued. SUVs kept growing, up 11% year over year, now making up 55% of the market.
Dominant segment.
While hatchbacks and sedans saw degrowth, down 12%, CNG vehicles saw a steep 30% jump in sales across the industry.
Huge CNG growth.
And EVs showed renewed promise, particularly in the second half of the year, with more manufacturers jumping in and launching new models.
Okay, so SUVs and alternative fuels were the main growth drivers.
Yeah.
How did Tata PV fare in that specific environment?
Well, these market trends provide important context. Tata PV actually managed to outpace the overall industry growth in SUVs,
Oh, good for them.
driven by models like the Punch and the launch of the Curve. And aligning with the market, their own CNG segment saw impressive growth too, 60% year over year for them.
Wow, even faster than the market.
Yeah, helped by their twin-cylinder technology and launching CNG in models like the Nexon. They also mentioned that a refreshed Tiago drove 20% growth for that model in Q4.
So they seem well positioned in the growing segments.
It seems so. They described FY25 overall as a year of consolidation for PV, focusing internally on streamlining processes to prepare for scaling up further. That included increasing their after-sales service capacity.
Smart move. Building the foundation. Tata PV's ability to outperform the market in key segments like SUVs and CNG really demonstrates the strength of their product strategy and how responsive they are to market demand. That focus on consolidation and service expansion suggests they're building a solid base for future growth.
So what are their strategic priorities for this year, FY26?
Their priorities listed are leveraging their strong current portfolio, further strengthening their EV lineup, more models maybe, enhancing their overall brand consideration on buyers,
Building the brand appeal.
mainstreaming EVs, making them more common choice, also expanding their sales network, both reach and quality, and accelerating cost reduction efforts across the board.
Sounds like a comprehensive plan for continued growth and better profitability.
Yes, it really does. These strategic priorities indicate Tata PV's ambition to further solidify their market position, really drive the adoption of their EVs, and improve their overall efficiency and profitability in the coming years.
Okay, so to try and wrap things up here, we've seen a really interesting, complex picture from this Tata Motors investor presentation.
Definitely a lot to digest.
Some key overarching themes seem to be a
Okay.
strong financial turnaround, particularly in profitability and debt reduction.
Yes, that's very clear.
A very clear commitment to the future of mobility, pushing hard on EVs and alternative powertrains like CNG across their businesses.
Absolutely central to their strategy now.
And some major strategic moves like the demerger that could reshape the company significantly in the near future.
Yeah, the demerger will be a big one to watch. Overall, this report provides a detailed snapshot of a company that's not only delivering solid results right now,
Which they are.
but is also very actively and strategically navigating a rapidly changing automotive landscape to position itself for future success.
This has been quite a deep dive into a very comprehensive report, and as always, we've really just touched on the key highlights here.
There's always more detail in the full report.
Absolutely, we encourage you to delve deeper if you're interested. But thinking about everything we've discussed, it kind of leaves us with this thought to ponder.
Okay.
Given Tata Motors' strong recent performance and their ambitious plans across JLR, commercial vehicles, and passenger vehicles, particularly with EVs, what do you think are the biggest opportunities ahead for them, but also maybe the most significant hurdles or challenges they'll encounter as the automotive world continues its rapid evolution?
That's a great question. Opportunities in electrification and potentially new markets, but challenges in execution, competition, and managing these huge transitions profitably.
Definitely something to think about.